So in 2010, I literally got a phone call that asked me some questions about insurance products and how they relate to indices, and that led to a job offer to come up and run the S&P or the S&P 500, but really the S&P index business as it related to the insurance market, like a race car. You put your foot on the brake when it's rough ahead or curvy ahead, and then you put your foot on the gas when it's clear road ahead. So that's kind of what 500 IQ is all about. We have some game changers coming. We think the 500 IQ was a game changer in the marketplace. I think it made a huge splash. We think it made a huge difference, but we're only getting started.
Systems work, people fail. Welcome to InsureMark's Advisor Mentorship Podcast with Vice President Jeremy Hauser.
Welcome back to this week's episode of the Advisor Mentorship Podcast. I'm your host, Jeremy Hauser, and we are officially into September and past Labor Day. So the kiddos are back to school and continuing to learn new things every day. With education in mind, our special guest today is Alan Grissom, who is the CEO of 12 South Capital, an independent firm focused on creating index-based investment strategies for financial products, and a founding stage partner with the direct indexing firm, the Brooklyn Investment Group. How are we doing today, Alan?
I'm doing great, Jeremy. Thanks for having me on.
Of course. And I think one of the things as we chatted here over the last couple of weeks, I would say, pretty exciting news about the Brooklyn Investment Group as an entrepreneur yourself. So when was that started?
Yeah, so we started Brooklyn December 2021, June of 2022, I think is when I officially joined up with that organization. So to be able to build something of scale, very disruptive in the space, and have that acquired in 3 short years is a testament to the team, the idea, the vision, what we thought direct indexing could be, and what it will be in this market. So, it's been a great ride with Brooklyn and now Nuveen with the acquisition. So we're very excited to have them as partners, and the future looks pretty bright.
I mean, it's incredible. So you basically came into Brooklyn 3 years later, sold the company. So that's pretty impressive. But I know originally when we were going to chat here for today, what really captured my attention and grabbed really my eye of your industry background, also a little bit about what you're doing in the fixed index annuity space as well too. So why don't you share with the audience a little bit about your background with the S&P 500? So what's your history there? And then also, so what are you up to now?
Yeah, well, it's interesting. My career kind of spans insurance and indices. And so it's a rare breed of both sides of this business. I started out years ago working for AIG as a product manager for annuity products. And over time, we developed fixed index annuity products. And that ended up being a really good space to be in, which led me to work for S&P. So in 2010, I literally got a phone call that asked me some questions about insurance products and how they related to indices. And that led to a job offer to come up and run the S&P or the S&P 500, but really the S&P index business as it related to the insurance market. So I started there in 2010. And if you think about the insurance market, for those of you who've been in the market for a long time with fixed index annuities, really was the S&P 500 and a couple of other indices in that space. Now there's several hundred, 200 plus, almost 300 indices out there in the marketplace now. So it's gotten wildly crowded. And we had a lot to do with that growth. But I had a front row seat in terms of the innovation that's come into this space from 2010 until 2022, where I thought there was some opportunity for disruption in the index business overall. So I had gone from just building the index business, focused on insurance there to actually running all of North America. So the investment banks, asset management, all that commercial side of that business for the last 4 years, plus the global insurance mandate. So it was a lot. But that led me to see some opportunities for disruption to the traditional indexing business. And, I've always been a business builder, whether that was the inside of my days at AIG or the inside of S&P. And I felt like this was one of those rare opportunities that you've got to go seize it. And ultimately, that led me to leave. And so we started Brooklyn The intent was to do the direct indexing because we thought that would be disruptive to our index business overall. Turns out it was. And that became sought after by the RIA community. And also the idea of the 500 IQ, that is one of the indices that we can talk about that 12 South Capital has developed and launched in conjunction with S&P. With the idea was born earlier with kind of figuring out exactly what was available in the marketplace, what pieces could we do at S&P, and due to some technology constraints, what pieces we couldn't do, which led me to have more confidence that I could actually do this outside of S&P and deliver a better solution. And when we came up with the idea of it, ultimately, we talked to S&P about this, and they wanted to partner with us. And so, that is, our index design, but S&P now owns the indices, and we get some royalties from it. But ultimately, the idea was, for me, in the insurance market, when I was leaving S&P, there was something left behind that I felt like that we hadn't accomplished in the insurance space, and that was really unlocking the power of the 500 inside of fixed index annuity products. You always dealt with the caps and the pars, and it's a function of option pricing. But at the same time, I always was challenged: is this the best we can do? Because I'm from the middle market, and a lot of consumers of fixed index annuity products are middle market consumers. And, I was always challenged and wanted to do the absolute best we could do there. And ultimately that was a goal. And so I felt like I was going to take a swing at that. And we found the way to do the 500 IQ, did it with S&P, and now we have it on products, and we've delivered some fantastic returns for the consumers over the past year, a little over a year, almost 2 years now since it's been launched. We have great stats on this. So it's, are we doing good? Yeah, we've done really some great things.
Introducing Eclipse Mark, fixed index annuities from Standard Insurance Company. Built for growth and with client value at its core, the accumulation focus Eclipse Mark offers interest crediting options that include a guaranteed fixed account rate for the length of the surrender charge period and a duo growth index option, get this, which credits a guaranteed earnings rate in down markets or index earnings plus a guaranteed earnings rate up to a competitive cap in flat or positive markets. Available with a 10-year surrender charge schedule up to age 80 or the 5-year version up to age 90. Eclipse Mark also offers a vesting premium bonus option up to 12%, extended guaranteed rate periods, and 15% penalty-free liquidity, giving you the flexibility to address a wide range of client goals. Discover what sets Eclipse Mark apart. Visit Legacy Marketing Group at www.legacynet.com or contact us today. Yeah, and I think that's something for like the listener as they're maybe hearing your story for the first time a little bit. We'll talk more about the index here as we move forward, but all advisors that listen to this show, they are very well equipped with volatility controlled indexes. They do a lot of research, due diligence on vol indexes in the FIA space, but also it's always interesting to hear other stories that maybe they're not accustomed to. So if you just, for very simple terms, talk about a little bit of the methodology of what that S&P 500, what is the 500 IQ? What is that? What makes that different than just your traditional S&P 500?
First of all, there are a lot of vol control indices in the marketplace. And, I would say there's a fair amount of those that have underperformed. So I'm going to talk about from 2012 to 2017 really was a period of time to me where we had a real bull market in the marketplace. And we had several indices that had a lot of money credited towards them that underperformed. Look, that may just be bad timing. There could be a lot of things that kind of go along with that. But at the bottom end of the day, consumers' expectations, advisors' expectations were misaligned with the results. And, that to me, I think this is a fantastic business. I think it's a fantastic industry. I think it serves a really great need. That bothered me. And so the real push was, what could we do from the things that I had learned in the indexing business? And you have to remember, the indexing business is not that old. The guys who hired me into the index business were very instrumental in starting, essentially commercializing the index business early on. So I know a lot of the key players who started this, and they had a philosophy about indices, passive versus active management, for example, or simple, transparent, easy to understand. All those things were kind of ingrained in terms of what we were trying to deliver to the market place for the insurance market. Things that I had learned from them that told me that, look, can we do these things? Yeah, you can. The more complex something is to me, when you make a rules-based methodology, to me, the odds are become less that it will actually succeed over time, because the markets are very complicated. If you're forecasting the markets, I'm a big believer that the markets will go up over time, but can I tell you if they're going to go up today? No. And nobody else can either. I'm just going to tell you right now, like if you run money or trade in the markets daily, you just don't know over the short term where this is going to go. You don't know for sure over the long term, but you have some good ideas. So simple, transparent, easy to understand. We're all ingrained in what we try to do at S&P over time. And that kind of flowed through to the 500 IQ design itself. So when you kind of look at a risk control index, for example, there's a lot of different types of risk control and how they're measured, how you measure volatility, all those kinds of things. There's thousands of different ways to do this, and they all have impacts on the returns. And so it complicates things. So again, my view off of this was simple, transparent, easy to understand. What can we do to enhance returns? But then all these things that you can do, what can we strip away in terms of cost? What can we strip away in terms of efficiencies that ultimately boil this down to, a race car, what I'm going to say, which is essentially something to get from point A to point B as fast as possible and as efficient as possible, right? So that's what the 500 IQ really is. Measuring volatility, you could measure it based on the last 90-day vol, right? What's the average of the last 90 days? Or you can and when would you report that? So typical volatility with S&P had been reported 3 days after the date. So there was a lag in volatility reporting. That created inefficient pricing for option pricing. And so the basic premise of the 500 IQ is, can we deliver that volatility and intraday, number one, so the measurements can be done much more efficiently. And that technology allowed that to happen. That's not Alan Grissom being smarter. That's technology evolving. Mm-hmm. And so, but we knew how to leverage that. And how would we apply that to a covered call structure? Also the design, when we designed a 15% vol target, people thought that I had lost my mind. Why would you do that? The highest vol target in the industry at the time was 10. And there was only one index with 10, and I was pitching something that's 15. Well, 15 happens to be very close to the standard deviation of the S&P 500. So the standard deviation of the S&P 500 is about 15.5 over 10 years. If we have a 10% vol target, then we're targeting about 2/3 of the volatility of the 500. If we have a 5%, we're targeting 1/3 of the volatility of the 500. If we're targeting 15%, we're targeting 100% participation in the 500. So the idea, again, was to target inside a risk control index, 100%. Your goal is 100% participation in the index. Now, if the hedging budget doesn't allow that, that's okay, but that's very transparent to the customer that they're getting 70% par on the 500 IQ versus 100% par on IQ. What we found was that was actually a good, really a fantastic, the intraday pricing allowed for 30% more efficiency on pricing, because the bankers, the hedge providers had more transparency into what the volatility was. The 15% allowed us to target 100% of the S&P 500 volatility, but lock that in. So if in times of high volatility, it moves down into cash. In terms of low volatility, it levers up to 200%. So you really, in periods of low volatility, when the markets in low volatility, the markets are typically increasing, you want to lever up in that particular space. So it kind of, the design allows you to, like a race car, you put your foot on the brake when, it's rough ahead or curvy ahead. And then you put your foot on the gas when it's clear road ahead. So that's kind of what the 500 IQ is all about. simple, transparent, easy to understand. Now, I did all that with the idea of this is, in theory, right, a math problem. This is what we want to do. Then, ultimately, when you launch it, does it really work that way? And we have seen, enhanced returns. In fact, we've seen the benefits so far of about 42% additional crediting to the consumers versus your traditional 500. And so, does that hold? That seems a little high, but over time, there's clearly is enhanced benefit and alpha to what we're doing. And, obviously I think there's a lot more to come with that. We're excited because the idea was, can we help people? We help people.
Advisors, ignite your practice with Prosperity Life Group's Path Pro series, launching right after Labor Day. Path Pro and Path Pro Max pack a punch. 3 custom index options, the S&P 500, and a fixed bucket, all with zero market risk, 0 explicit fees, and a massive premium bonus on the Path Pro Max. Lock in guarantee rates with the custom indices for 5, 7, or 10 years with issue ages up to age 85. Prosperity Life with $25 billion in AUM, A- ratings from AM Best and S&P, and 100% renewal rate integrity since 2018 has your back. Supercharge your clients' growth at prosperitylife.com. Yeah, and I think so for the audience of the advisors, which that was incredible, of explanation of what the 500 IQ is, but also as the listener, this is going to be in the weeds a little bit. So this is for sure for some of those advisors. I have some analytical ones that are going to really enjoy this episode. This is also going to be just blocking and tackling of what to look for when it comes to creating volatility controlled indexes to give you a good view of what's happened in the industry here over the last several years. So we're going to have some questions around that, but also you're going to pick up some huge nuggets here from Alan, who's helping design some of these indexes. So get your pen out. This will be very worth your time to learn a little bit more, but I want to actually park on one of the questions that came up in my head. So you mentioned 15% vol index. Everybody's looking at you a little bit crazy. Well, and I'm a very simple person, but I think what helped in your favor is this was being looked at in the lens after 2022. So the 10-year treasury was a little higher, correct? Mm-hmm. So
that's correct.
So there's a little more grace there, or kind of walk through how is that beneficial for you when it comes to creating these indexes where you need the interest rate environment to be a little more favorable?
Well, let's talk about what is interest rate environment historically versus what we've seen, right? So from 2010 to 2022, we saw what I would say an abnormally low interest rate environment. So the 2%, is that realistic? I mean, when you start hearing Jerome Powell, the Federal Reserve Chairman, talk about where are we going? Historically, we've probably been around 4 to 5% in terms of fixed rates, right? Mm-hmm. So, I think we're more normalized now as opposed to being abnormally low. That doesn't mean we can't go back to an abnormally low interest rate environment, but that just, to me, that also, that has its own problems in terms of we didn't see inflation for a decade, but we saw inflation after COVID, right, with $8 trillion pumped into the economy, et cetera. So how do we adjust for these things? The way I see it, and I'm no economist, but I do play one on TV sometimes. I do understand economics pretty well. To me, it seems like we may have a slightly lower interest rate environment going forward, and that would be a little detrimental to the 500 IQ. But I'll tell you this: we've had ups and downs, slight adjustments on the interest rate environment since that launch. So the index itself launched in July of 2023. It went live on a product in September of 2023. So we've seen ups and downs in terms of interest rates. What we were able to see is great stability in the pricing. So our caps and pars virtually have stayed, and our renewal rates have stayed virtually in line. So within 1 or 2% of that. And I'll give you an example of that. They've always been 50% higher than the 500 caps and pars. So yeah, it can be effective, but how much and how deep does a cut have to go before you end up with something lower? And if that happened, we have a plan in place for lower interest rate environments, but I feel like, if you're targeting the index construct that we created, even in a lower interest rate environment, you're going to deal with a lower interest rate cap on the 500.
Mm-hmm.
So relative to the 500, this construct should allow somewhere between 30 and 50% higher caps at all points in time. Now, if the correlation to this index to the 500 is high, which it is, it's around 9.98 that S&P gives me. That's the number they provide. That means that we are highly correlated to the 500, but with 50% higher caps and pars. I like that idea for higher performance. That doesn't always guarantee that you're going to get higher performance, but it does mean that you are likely to get higher performance. And again, our numbers, our analysis, it really shows that even though rates have been up and down a little bit, that overall crediting by the insurance carrier to the customers was somewhere in the neighborhood of about 1,800% overall. That's the aggregate crediting. How much do they credit out to the policyholders over this time period that we could study, which is all available data, by the way. It was not cherry-picked data. Just since launched to the latest data we had was about 1,800% for the 500 IQ and about 1,200% for the S&P 500, which had 8 to 9% caps. That means that our customers got about 40% plus or 50% more benefit by using the 500 IQ on an aggregate. Did it mean that each individual customer got more higher credited rates? No, there's periods of time where the markets were changing, and we'll talk about that hopefully in a few minutes. This year has been particularly challenging for these types of indices. But did that mean that we overall, the customers as an aggregate did better? Yeah, it did, actually. It meant that it is decisively better. How much better? I mean, we saw returns on participation rates 30 to 40% in 1 year for these customers. Now, look, you're not going to get that every year. And if you set those expectations, that's completely wrong. And they're not set by me, number one. These are safe money products. You should expect some type of safe money type return. What we did see were those were returns. Will they hold up? Highly unlikely over time, but they were locked in for the customer. So if you locked in what we think is a typical rate of return on an annuity, somewhere between 5 and 7%, if they got 30% in 1 year, they're setting pretty good in year 2 or year 3 or year 4, right? And that's not to set the expectations that should always happen. That's just saying that we did some good and customers benefited from it, and we're likely to do well again in the future with that. We do have a high degree of confidence that this type of construct really unlocks value for customers. We feel like that. There's a lot of groups that do it. We feel like we do it really well, better than anybody. But that's just our view.
Like you said earlier, so there has been a lot of market volatility, especially in the first half of the year. So is that good or is that bad for volatility controlled indexes, and why?
Well, I'm going to give you an analogy here that makes a lot of sense to me. You're in a snowy region, and I know you're in Houston, Texas, so this would not be you, but you're in a snowy region and you're going to go to this town and it's just across the lake. You can either walk across that frozen lake or you can go around the bridge and get to that town. Now, let's say you walk across that frozen lake and you get there. That's fine. But should you have taken that risk? Probably not. If you don't know how deep the ice is, right? That's a little bit about what's going on right now. The 500 is done. We've had a good year so far, year to date on the 500. Risk control indices, by and large, have struggled year to date this year. Why? There's a lot of volatility in the market. That's real risk that people are either recognizing or not recognizing. And when you kind of look at Pershing, like Bill Ackman's private equity firm or his hedge fund, it's those have been negative year to date as well. So there's a lot of risk out there in the marketplace. A lot of big investors are sitting on the sidelines, or when they're participating, it's not working out in their favor. That's because there's a lot of risk out there right now in the marketplace. We're at all-time highs. Donald Trump tweets, and he sends the market, the NASDAQ flying 600 points in one direction in a minute. And all of a sudden, that's real risk. If you're sitting on either side of that trade, that's a lot of risk. These volatility control indices have picked up on that. They've shifted to cash. I'd say most of them have shifted down in terms of their equity exposures. Fixed income, for the ones that move into fixed income, have not always been a safe haven as well. So yeah, it's been a challenging environment. Has the markets kind of evolved to Trump's tweets, which have been his threats of tariffs have been very impactful in the marketplace. His tweets themselves have been impactful. Like last night, he talked about firing a governor of the Federal Reserve, right? And that sent the markets into chaos. They have normalized somewhat, but they haven't normalized completely. Has he done a lot of good things for the markets? Absolutely. But we have to feel like the foundation is also right sizing before, I think these indices normalize and the markets settle down a little bit, because what we've found is, by and large with Trump, his bark has been a little louder than his bite. And as the markets normalize a little bit on that, that will help everybody to be able to understand it's a new regime, and that we feel like that they are doing a lot of good things, and that the markets will react in a manner that more reflects his posturing in the market.
For full clarification, he truths, not tweets. Because he's
very true. That's a great point. That is a great point.
Because that entity, disconnected him. Ibexus believes focus is power. That's why they have built a smarter, faster approach to annuities centered on product, process, and partnership. With no legacy systems holding them back, their fully digital platform delivers lightning fast turnaround, seamless applications, and transparent service. Ibexus designed a best-in-class suite of accumulation products like the FIA Plus and the Wealth Defender, and partnered with a select group of IMOs who share their values. The result: simplicity, speed, and long-term value for everyone involved. For more information, go to www.insuremarkamp.com/jhauser and click on Learn More. Discover how focus fuels performance. Discover Ibexus. Welcome to the revolution. Fueled by agility and an innovative product engine, Revel One Financial is excited to introduce the Interest 10 Income FIA, their latest fixed index annuity. With a powerful guaranteed lifetime withdrawal benefit, it delivers income for life with the potential to grow each year. Talk to your clients about Interest 10 Income if they want to know today how much guaranteed lifetime income they could receive, if they're looking for protection against the rising cost of living, and if they want a lasting income they can't outlive even when the account value hits zero. Pretty nice. Get all the details at revel1financial.com. Revel One Financial, revolutionizing the norm. So basically what I'm hearing is, yes, there's been a lot of volatility on the volatility controlled indexes. It could be good. It could be bad. Seems like maybe in a 5% volatility controlled index, it might be a little more challenging than for, say, a 15 or vice versa. But let's talk in real numbers here. So like the last 2 years, I've had some guests on as well too, because I just love picking each one of your guys' brain because y'all are smarter than me. So last 2 years, I'm simple. S&P 500 has been up over 20% in 2023, over 20% in 2024. Mm-hmm. And we're having some of these volatility controlled indexes after 2 years. Goose eggs are barely positive. Why is that? So walk us a little bit through. Every index is different. Every insurance carrier might be different. Their pricing of products different. On a large scale, to the advisor who wants to know, like, why is my index returns on this? How is this flat when this has been up? Can you walk a little bit through the blocking and tackling of that?
Oh, absolutely. So let me kind of give you a little bit of a line of sight into that. Number one, again, it goes back to my original philosophy on developing indices: simple, transparent, easy to understand, right? So getting exposure to an asset class that makes sense for a consumer of a fixed index annuity is paramount to what we want to do. The construction of indices. So for example, when you have a low interest rate environment, like that would warrant a 5% risk control, which would mean that we're in a low interest rate environment. They're trying to get higher participation rates. They're targeting lower volatility. That really means you get less exposure into the equity component of that volatility part. and you get more exposure into the other alternative asset class. That could be gold. It could be fixed income. It could be cash. It could be all of those. And how it allocates in between those really kind of matters. So if you kind of look at that and understand that, okay, my index, number one, what is it targeting, right? What is the return profile that we're trying to create in this index matters, right? So you look at, the NASDAQ 100 or the S&P 500, we've had great returns on that. But the Russell, the small cap has not had great returns over that period of time. So if you were targeting small cap versus this, your returns may be more muted just on a pure index basis. If you are targeting the 500, for example, or the NASDAQ 100, it's okay. What vol target were you at? So the NASDAQ runs a vol target of about 22.5. So if you're targeting if you have a 7.5% vol target, then you're targeting really a third of the return of the NASDAQ 100. So number one, are your expectations 100% return of the NASDAQ, which would be, higher than the S&P 500, or are they lower, right? So what does that look like? And then how was that delivered? So we've seen a lot of indices that measure their vol targets in ways that may not be efficient as well. We talked about using intraday versus your traditional old risk control indices. That means there's higher pricing and efficiencies in pricing. Those have all come to fruition and really are kind of exposed when the markets get larger as well. So when the budgets for the markets get larger, right? So you have the propensity to really have a lot of these indices, and there's a lot of risk control indices. In fact, a majority of them were designed or developed well before intraday became popular. So they have old technology. They may have exposure that was designed for a low interest rate environment. And that also creates some underperformance. They may have a low vol target, which means they've got low equity components of this, and it's sitting in cash a lot of times. It may trade too many times. So it could be expenses that are embedded in this that the advisors were not savvy to at the time. So there's a lot of things that can kind of go on with this that kind of lead to underperformance. Frankly, with the 200 or 300 indices that are out there in the marketplace, I personally feel that a lot of that should be cleaned up, meaning that a lot of these underperforming indices should be sunset, I guess. Maybe they should come back at some point in time, but I doubt it. I feel like that the new intraday vol targeting is really the future for what we're trying to do, because we've proven that there's, and not just S&P, not that 12 South Capital's concept or the IQ concept. It just means that the intraday vol targeting is much more responsive. There's much more efficiencies in pricing from the investment banks or through the exchange or whatever you're trying to do. That unlocks value, and it unlocks value for customers, right? So that matters. We have the technology. We should use the technology. We should update for those things.
So are you saying, I heard something you just said there for like the fees that are incorporated into the product itself. So are you saying that on a daily basis, some of the indexes that are out there that have the opportunity to go and rebalance within the day, that's not necessarily always a good thing to do because there's fee like drag on the returns?
Everybody's going to have their own opinions about this, but I'm going to kind of give you my opinion. Again, I'm more common sense, but there's a guy named Warren Buffett. How many times do you think he trades in a day?
Right. Okay.
Maybe once, right? Maybe once, right? So there are other indices, and I just some that kind of come to mind that rebalance 13 times a day.
Yeah. If
we rebalance 13 times a day, I can tell you, I haven't had a day where we're winning that day. In fact, that 13th trade is probably, please, let's break even with this thing kind of goes, right? So it's a situation to me where what is the most efficient outcome, right? So when we developed the IQ, we looked at how many times do you rebalance in a day, because you could rebalance by the tick, like literally as the markets move by the tick, which is less than a second, you can all of a sudden rebalance, but there's a cost associated with that. So what's efficient? And so ultimately we found that being efficient mattered to us. And we found Other people may find something different, but 98% of the benefit was one rebalance in a day. And so to me, if you get 98% of the benefit from one rebalance, do you want to spend a lot of calls trying to get the last, 1.9% or 1.7% of the efficiency out of it? Well, again, learning from the guys in the index business, efficiency matters. So low cost matters. We think over time, low cost and efficiencies will outperform what we'll call active management, right? So that's what we've seen. It's what I've seen. That's what I believe in. It's what we try to deliver on.
Right.
And I'll give you one example of that. If you rebalance 13 times a day at 2 basis points, that's 26 basis points of cost or drag in a day. 252 trading days, that'd be 65% of your return that you would give up on trading and rebalancing. Now, that's not going to rebalance 100% in a day or each time. But let's say it rebalances 10% each time, which it will do that. That's 6.5% that you're giving up in terms of returns every year just for the rebalancing feature. Did it outrun that in terms of performance? We didn't find that to be the case in our research, but that's our philosophy. I believe that simple, efficient, transparent, easy to understand, and when we do it, matter. And that helps with the story. That helps also explain to the customers how it works.
Here is financial planning software to make you shine. Retirement Analyzer software by Thomas Gold Solutions helps advisors nationwide create easy to understand financial plans for their clients. Today's successful advisor understands that clients are in need of advice, recommendations, and projections of possible outcomes that are provided in a financial plan. Thousands of advisors using Retirement Analyzer know that they are a formidable force in today's industry. They know that clients buy certain outcomes, which include sales of financial products. So in essence, products are not the focal point, but just part of the plan, helping them get to their desired outcome. Retirement Analyzer gives you the ability to answer any and all client questions while building plans to address certain concerns. Acclimation is a breeze, and their over-the-top user training and support platform is unparalleled in the industry today. So start today and request your 14-day trial to find out what it's like to be a part of Retirement Analyzer community of advisors. Go to retirementanalyzer.com and get started today. So what would be like a cheat sheet almost of an advisor who's maybe been writing some indexes and it's been subpar? Obviously, it's not going to be exactly what the performance of the S&P 500 is, because obviously there's participation rates. There's a reason why the par rate on the S&P might be approximately half or a third of what a par rate is on a volatility controlled index. So if there was like two things that they should look into, very simple to know what the time is of the index, what would be the two things you would point that advisor to see if like, okay, all right, I understand this index a little bit more, let's move forward with this? Or based off of these two things, maybe this isn't a good fit for what I'm currently writing?
I always start with the business of what are you trying to accomplish with this? What type of product are you on? Matters, right? So are you doing an accumulation vehicle, or are you also in an income product?
Let's just say accumulation for this. Yeah.
So for accumulation, to me, number one, what am I trying to target? Am I trying to build like outsized returns within this? What's my risk tolerance for my customer? Because what I have seen too, and this is not a testament to the 500 IQ, but we did have a few more zeros relative to the 500 in our research paper that we produced. Not many more, but we did have more. And so, a customer getting a zero return is not something I'm proud of. But at the same time, if they get a high return one year and a zero the next year, and they're all net much better off, I feel like we still did some good for the customers. But I would say, number one, what type of narrative am I trying to establish with the customer in terms of expectations? And so the underlying matters, right? So is it a NASDAQ type return? Is it an S&P type return? Is it a different type of return? And then the second part is what we're trying to do. What's the track record of this? What's the history of this? Is it simple? Can I understand it? And then what's the performance history? A lot of indices are designed, and we don't do this, but there's a lot that are designed based on illustrations, meaning that they...
back testing,
yes.
even though, exactly. Right.
And so we don't do that. We stay as far away from that as possible because, frankly, I didn't know what the 500 IQ was going to do when we did it. We just had an idea off of it. But to me, when you're doing back testing and creating those types of indices, it's definitely a poor indicator of what the future holds because the markets are different every day. And frankly, we see that, we all see that. And it's a matter of, we should see about the philosophy that we have, which is how do you get exposure to a specific asset class, et cetera, and not, if I chose NVIDIA and Tesla in 2010 and then NVIDIA and all these kinds of things. So I could create an index that shows you 1,000% return every year for the last 15 years. I promise you, I can do it. But it doesn't mean I'm going to do that going forward. That's just not the way it works. So, having some confidence that these are safe money products. There should be safe money returns. So those expectations should be in line. And then looking at what is this happening? What's the history of the index itself? And then what does that look like in terms of the construct? Do I understand it? And does it make sense for what we're trying to accomplish? And is it efficient? Is it cost in terms of what we're doing, or is there inefficiencies in this, right? So dig a little deeper. I encourage everyone to dig a little deeper. Most people don't. Most organizations that look at this don't. And, but that's where the friction lies, and creating friction or drag on the performance is what ultimately separates expectations from reality. And, we really like to try to deliver, on those expectations to kind of get those in line. Are we perfect at it? No, but we are, we feel very confident that if there's a deviation from that, we have, a good rationale for it.
So intraday is very important with y'all's philosophy. As of right now, within the marketplace, I think a couple carriers have now caught on. It's not just one. I think a couple carriers are starting to look more into intraday, but especially y'all's index is found on a couple of carriers now, right?
It is. We've had a lot of adoption. You'll see a lot more carriers picking this up over the next 6 months as well as they're rolling out new products. But yeah, we've had a lot of, we've had a fair amount of success over the last 6 to 12 months in terms of that. We have a lot of new indices coming to the market. We have, we're well past the 500 IQ, which we designed. The 500 Market Agility won Best New Index at Structured Retail Products. It's up 11% this year. That's another one we do with S&P, but we do indices with NASDAQ, Bloomberg, and Morningstar. There's a lot of different organizations we feel have really underappreciated assets, meaning specialties in terms of the indices that they've created with liquid markets. S&P has a clear advantage on the 500 because there's a market for that. There's futures, there's options, and all those kinds of things. They have a full ecosystem. NASDAQ has the same thing for the 100. But beyond that, I would have to say that a lot of the other ones, Bloomberg has the bond, the fixed income side. Each one of these organizations have unique characteristics in terms of what they've done. And we really try to work with them to unlock that value and bring it to the customers. And you're going to see some great things from us. We have so many neat, innovative, what I think are neat, innovative solutions that'll be coming to market that we're really proud of and excited to deliver into this space.
If there is anything, and anything on the horizon. So it sounds like, outside of y'all's company, y'all got some pretty cool things for inventing and not necessarily inventing, but more so thinking outside the box, creating some disruption, I would say, also within the FIA space. But is there anything on the horizon this year that has you pretty excited that you could maybe even share that's not, too in the weeds?
It's a double-edged sword because if I share with you what I'm doing and I'm working on, we'll say that imitation is the greatest form of flattery. We've been very disruptive in the marketplace over the last couple of years, much to the chagrin of a lot of our competitors. And so I have to be very careful. My team really has to make sure that I don't say too much about what we're working on. But I'll tell you, we have some game changers coming. We think the 500 IQ was a game changer in the marketplace. We think it made a huge splash. We think it made a huge difference. But we're only getting started. And, I've built an army of believers, of advisors out there who really follow what we do at 12 South Capital, who really have dug into what we do, what we're building. I'm very appreciative of those guys who gave me a shot to kind of come out there and deliver in their space and help them, deliver more business. And, we take their inputs very seriously in terms of their needs, et cetera. And we're delivering fantastic things coming forward. I couldn't be prouder of what we've been able to accomplish so far, but the relationships that we have built along the way that are, they really have shown who could help us, who wanted to help us, who wanted to be part of this change. And, ultimately we have, we've delivered for them and they've delivered for us. And we're only getting started. We're changing the game out there. I have no doubt.
Yeah. And I think for especially, as we're wrapping up here, it is interesting kind of watching the journey of and by the way, just so people know, okay, IQ 500, what is this? Obviously our team has some good data on that information, but for those that are listening right now, where can they grab that information? And also, you do a lot of analysis with the S&P 500 too. So what are some good resources they can go to?
So they can go to our website, www.12southcapital.com. Is one, if you look on our research page, we'll have a research paper out there on the 500 IQ versus the 500. It's really just showing analysis of real world returns between those two based on actual fixed index annuity products, not theoretical, in terms of, in the future of what would happen. So these are, since it's launched, what happened out there on the products. We'll kind of get into caps versus pars on another white paper. This is just a cap versus cap. So you have a really equal comparison across the board. But you also can look at S&P's website for the 500 IQ. And that is, S&P Dow Jones indices. Under indices, the 500 IQ is out there as well. You can also check the carriers' websites, our carrier partners, but also, we're doing things with Bloomberg and others. They'll be listed on our website too. Some of that's protected, again, due to what we're working on, kind of matters. And so, but at the same time, we really want advisors to have confidence. Contact our team if you have questions about anything we're doing. We try to really be open, transparent. We want to make sure that we are alleviating any concerns, so people understand what we're doing, why it's there. I think there's a solid rationale behind it. We speak at a lot of events to make sure that they, and I'm an open book. If you've ever seen me speak, we have the presentations, but man, just ask me questions off the cuff. I designed this. Like, if I don't have a rationale behind what I'm doing, I have concerns, right? And also, another part about this is, you have a lot of people selling you indices out there. How many people quit their job to go do it? Like, there ain't many people who do this. I can tell you right now. And so are we disrupted? Do we feel like we're disruptive? You don't find many people who feel like they could be that disruptive in the business to go start two companies. One that's sold already, and one that's been very disruptive in the space. By the way, I do want to point out that that 12 South Capital is wholly owned by me, nobody else. There's no other investors involved in this. So ultimately, we're completely independent in this space. And we felt like that was important as well to have, to be able to deliver independence in terms of what we're doing and we're trying to deliver. We do partner with great distributors of products. We do partner with great insurance companies and product design shops at times. But all of those things are ancillary to what we do, which is independent across the board. That's why we're able to work with an S&P or a NASDAQ or a Bloomberg or Morningstar, et cetera, across what we think are the best ways to deliver those solutions. And ultimately, that unlocks value for the customers and everybody wins here. And that's the goal, right? Let's let Main Street win for a change.
Outstanding. And appreciate your time, Alan. You're doing great work. So I thank you for sharing a little bit of your story, and then also have a feeling it's going to continue to succeed year after year here. So looking forward to maybe having you on in the future. And also thank you to the listener for tuning in to this week's episode. Make sure to subscribe on your favorite listening device to the Advisor Mentorship Podcast. Subscribe to our YouTube channel at Jeremy Hauser AMP, and also connect with us on LinkedIn. And remember, as you share this episode with a friend or a colleague in a world full of betas, be an alpha.